Thank you, Amy. Welcome, folks, to the meeting of our first risk committee. I'll start saying Happy New Year, but I guess I'm effectively KAM saying Happy New Year. It's great to be here and appreciate everything that staff's done to get us here. And to staff, and the friend down there is public, welcome as well. It's good to have everybody here. I appreciate it. And for those that might be joining us through digital means. So we are recording the meeting. I think health and safety, you folk know it better than I do. And you know where the signs are. Could folk join me, please, in the opening Eric here.
Yeah,
Marino,
Brilliant, thank you for that, appreciate that. Right, so to little agenda. Any apologies, we have one from Mayor Martin and one from Woody. That's it, so I'll move from the chair, we sustain those. Thank you, Colin. Put the motion, those both please say aye.
Aye.
Those against, it's carried. Conflicts of interest, any matter coming up that you look at those things. There is, thank you. Hello, before I forget. Congratulations, you're deputy chair now, aren't you? You're my deputy, and this first meeting is deputy chair.
Please don't draw attention. Don't draw attention to it.
Congratulations. I was going through the minutes and realised that we elected you, Martin, which is tremendous because I asked for that because it was going to help me in case of availability issues. But it's great to actually, I should acknowledge.
No, thank you.
We've got acknowledgements and tributes, I guess, but you're on board as deputy. That's tremendous to have there. Are there actually any acknowledgements or tributes for the community we should recognise at this stage? No. Public participation, haven't had any Amy at this stage. And there are no actions. Obviously, there's no urgent business that we've confirmed at this point that there is nothing to add to our list. So we can move to the minutes of our last meeting, which is 9 October, so long ago. I move from the chair that we take them as a record. Do I have a second, please? Thank you, Kay. Any points of accuracy or correctness we need to note? Actually, sorry, we've got two lots of minutes here.
Yes.
9th of October was not our last meeting, effectively to ourselves as the grants committee. Sorry, I will take them separately. So we've got the 9th of October. Any accuracy questions or need to make? I'll put the motion in and we take them to record. All those in favour, please say aye. Aye. Those against, it's carried. We just move to the minutes then of that last meeting to the 17th of October. Again, I'll move. Do I have a second, please?
Happy to second.
Thank you, Colin. Any comments, corrections that we need to make? But pretty much like the meeting I was in, and I think I'm pretty comfortable with anything that I feel really like that is so that is wonderful. So I'll put that motion, all those in favour, please say aye.
Aye.
Those against, it's carried. I'm just trying to stick to your nice minutes here. So we're agreeing this. I don't think any minutes arising from the previous minutes. So while I think probably halfway through this, we would hope that Earl Benforth would join us over our position, particularly around our debt profile. Let's kick off anyway the finance section. If we have to come back to Earl, we will, Charlie. Otherwise, we'll just take it.
Yep. Thank you. Thanks, Chair. I'll take the finance report as read, but as a summary, we are, as is our pattern these days, very close to budget in the majority of our finances. Historically, things like the roading program do tend to pick up in the second half of the year. So, but you will notice that the roading operating costs are overspent for the year to date, and that is largely because of emergency works. And so we haven't had some of those storms necessarily recently, but there are hangovers from previous ones that are still being fixed up. So that's the overspend there. And there's a little overspend in planning and regulatory services, and that is due to ongoing work for the two plans that are underway at the moment. We have a number of programs. Actually, on the second page under executive summary. So, yeah. Rates, the reason rates are slightly under budgeted revenue target for the year is because there was a little bit of an unknown as to how those remissions from the SERPs would hit the accounts. So that is the sole purpose. In terms of the core rates itself, we are on target. It's just that we've had more remissions than we knew to budget for. So that is something that we will bolster in future years if that's the way that we continue to handle SERP.
Can I just ask a question through you, Mr. Chair? Just in terms of remissions on soups in particular, what you anticipated as against what we've charged for was significant in terms of the number of remissions that you had to provide after obviously we did a little bit more research in that field?
Yes, it was significant, and I think it has continued on because of the investigation and the work out in the public. People have become aware that there are remission grounds that they can apply for. So, but obviously that's the purpose of those remissions, is that we allow the support for those people. So,
Excellent. No, thanks, Charlie. Thanks for your work in that field.
And if we're doing questions through, just the one debtor of 129,000 of these. Heard about that before, but
quite got there yet.
all right.
Wait
till you get there. Okay.
Yeah. So the statement of financial performance is largely as per budget, other than the planning and regulatory. Water is a little bit behind the program this year, but we're assured by our partners that they will catch up on that. That's the operating part of the waters.
Through your chair, just on the water, and we sort of, with Wellington Water, we were just talking before about a couple of those other quotes that we received for local. We're still sort of really concerned about, I guess, future financial shocks from Wellington Water until we exit transit out. Anything we could.
I think in terms of the operations, they're pretty much under control. There's it's pretty routine stuff that goes through there. I mean, there are reactive maintenance issues that are going through there, but for now, I'm quite comfortable with where we're sitting.
Okay.
We'll continue to work through that in the next 6 months.
Thank you.
Balance sheet at the moment is healthy. We have a working capital of 2.3 times our liabilities. So our current assets, our ability to pay our current liabilities is 1.3 times. Which is healthy, obviously. Loans and investments are on track. We work closely with Earl on particularly our loans and the lengths of time to lock those in for. It's the capital program, which, bearing in mind these reports are as at December because of the timing of the meeting. Overall, the capital program is 17% spent for this year.
17
spent for this year. However, 6 million of that has been reforecast out into year by Wellington Water. So they had a 12 million budget for this year, and they are advising us that they're going to spend 6.5 million of that.
Okay.
Largely because of a couple of large programs that have moved out into the next year. So we reforecast that all the time in our long-term plan position. But once you take that out of the mix, that does become much healthier.
Yeah.
And anecdotally, I've been advised that the presence of a project manager in council has made a huge difference to how our programs are getting off the ground. So That's a relative thing.
And Waka Kotahi subsidies, I mean, we're
Yeah, so obviously, as you know, the low cost, low risk program was not funded at all. We have now applied for several items, I believe, independently. So we've made applications separately for the second round.
Okay.
It's currently underway.
okay.
We do have a capital plan item coming up before we get into PX, Charlie, but just to help me chase the numbers. On page 31, we have a forecast position of $12.6 million spend.
Mhm.
If I read this correctly, against our original budget of 31 million,
Yes.
correct?
Yep.
But that 12 million does or doesn't include, well, I think it's now about the $8 million clean spend at Wellington Water.
So that includes the Wellington Water spend.
So I looked up at water supply, wastewater and stormwater and the forecast.
Oh, you're right. There's no forecast in there. Yeah, you're correct. So there's a 6 million forecast.
Should be a 6 million there. So
Yeah.
so it's an 18
Yeah.
million we're an forecast position, an $18 million achievement against a $31 million budget. So we're behind us, but I think what I'm hearing you say is, and I don't know the timing of getting project members on board, that's starting to rapidly improve, but we won't see this until next year.
Yes, and we do have some rather large for us, discrete projects, like things like the stage one of the Wheels Park and those kind of things that will progress rapidly now that we're in the stages of.
So, I mean, look, the critical question here is, and if we can save it for the later table, I feel it's a critical question. This also affects presumably our debt profile.
So we're way
We're
behind
carrying-
where our
carrying-
profile is.
We are carrying less debt.
Yep.
Interest costs go down. I mean, there is an upside, but of course, the critical question is there any particular community planned community service that they're missing out on because we can't deliver our capital program?
You would argue that the low cost, low risk is probably critical of those things, particularly in light of recent events.
Yes. People.
Yes.
Yeah.
Obviously, we're in the first year of that 3-year window with Waka Kotahi at the moment.
Yeah.
We're on sort of a holding pattern until we find out about the second round of applications.
Yes.
What they'll fund.
Yeah.
And also from the community as to what their position is in terms of 100% funding that.
Yes, it's not.
Not, yeah.
So that's the 100% program of low cost. We've got LC. Think Tony?
LCLR.
LC, yeah, low cost.
It's low risk.
Low risk, sorry, thank you. Sorry. The 400% is included in the 31 million.
Yes,
Yeah,
yes.
so
Because that was our budgeted program.
Yes. that's right. That's what I should. So, critical at this stage, say that probably is the kind of thing I hear. Yes, I should acknowledge that there's sensitivity around here, very real. Okay, thanks, keep going.
Let's
Yes,
go on
questions.
to rates. So reiterate, total rates outstanding at December 24 is 1.35 million
Outstanding.
standing.
Is that the highest we've seen for some time?
That's got to, yeah, that's growing.
It has come down since, for example, October.
Mhm.
But it is creeping up every year.
Mm.
And if you look at the number of properties, there's a bit of a movement in those. So top right of that page, you have the number of units owing. And pleasingly, Featherston has come down.
It is 353 against 536.
Greytown is
Mm.
much of a muchness. So Martinborough is our largest, it's our largest ward though as well, because if you remember, Martinborough count includes all that big coastal area.
Does, yeah.
So we, sorry, Pat.
Yeah, let's start other things. So I was just wondering how if there's one area which is a much bigger percentage of
So the
Properties.
if you have a look at the number of properties and then the average debt,
Yeah,
Featherston has gone up. So it would be fair to say that the number of people in Featherston who owe us something has gone down, but the ones who are struggling to pay have increased the amount that they have to pay. Yeah.
but, because I just look across the different areas though, if it's a Greytown and Martinborough, what would be the biggest percentage? Because this tells us the number, but not the percentage.
Well, Martinborough is the biggest percentage out of those three wards.
Yeah.
With Featherston having the highest average amount outstanding.
Yeah.
So that kind of raises obviously sort of cash flow risks, doesn't it? Brilliant. I mean, potential collection issues on this.
Yeah. We are more closely managing our cash flow these days. Additionally, that's because our policy changed last year not to keep those term deposits for loans. So we have been gradually reducing the amount of loans we've got as those term deposits mature.
So
Whereas in
so
past years, we would have had a fairly continuous maturity of term deposits that could hold us through temporary positions.
does that mean our investments are getting lower?
Absolutely.
Yeah.
By the end of this year, the only investments we will have are either very short-term ones or the one that's held in trust for Paint Farm. So that will be our position, but conversely, we will have much less debt than we would have if we hadn't used those investments. And we're now, at the beginning of this year, it was actually better for us to keep investments and increase the loans because the rates were better. But we're getting to that position now where the benefit of having money in investments is not outweighing the interest that we'd be paying on loans. So working very closely with Bancorp on that timing. Yeah. And speaking of,
Earl is online.
Earl is online. So if we skip over the debtors for now and just go to treasury and we can go back to debtors.
I'm sorry if my picture's not too clear, but it's only I'm in Thailand and it's early here, so apologies.
G'day, Earl. Bruce Robinson here, the Independent. You're going to see you again, Earl, when we are.
Earl,
Hey, Bruce.
Do you want us to put your presentation up for you? Or do you just talk?
Is it easier if I share it?
Yep.
Okay, so just one sec, I'll just do that.
So we've got the report from Earl here in your agenda, but I'll kindly put together a presentation as well.
I probably need to share the right thing and then that would be helpful. Just one sec, I'll get that up. Can you all see that?
Maybe go to presenting mode.
Yeah. With your full screen.
Oh, it's our Bruce's decision.
So everybody can see that presentation now.
Yeah, can you go to slideshow though, Earl?
Yep, I'll just
Slideshow, please, Earl.
I'll just get down to there.
Right.
The wine glass.
The one that looks like a wine glass.
Keep going,
Right.
keep going. Here we go.
Oh,
No. Go back to your left.
there.
No, one to your right. One to your right.
No, I can't.
It's a wine.
Yeah.
Yeah.
Wait on. Yeah, there I go. It was hidden.
This one, Chris.
It was hidden by a icon. Perfect. Okay.
With final demand.
So Earl, look, your timing is impeccable. We're just just been considering our balance sheet, our debt position, and in fact, indeed, our investment position and what we have been doing. So, and reference to Bancorp was made as our advisors. So we're right on time. So we could go straight with your presentation, Earl, as it stands at this question, and I can ask a question.
Okay, so here's where we were at the end of January. So we had net debt of about 20. We had gross debt of 29.9 million, but there was a maturity in early February, and we were repaying we repaid amount of debt. So our net debt was 26.9 million. So according to the Treasury policy, we would be slightly out of hedging parameters, but the policy, unless debt is in excess of 30 million, it's at the CEO's discretion, and the discretion is that we leave it as it is at this stage. We didn't need to do any preemptive hedging. So that was the actual net debt position at 31 January. And as Charlie was pointing out earlier, this net debt position is much lower than what would have been historically with a gross debt and a term deposit counterfactual. And you know, the reason for moving away from that is that the margin that we pay on debt is not being compensated now for what we can get on term deposits, given that the Reserve Bank has significantly increased the cash rate. So that free arbitrage that existed for a couple of years, quite frankly, for highly rated entities such as councils, where they could borrow effectively from the LGFA and invest for short terms at a higher rate, has disappeared. So that's one of the reasons why we've rationalised that situation. So that was the position at 31 January. And there was the actual debt levels, and as I said, 3.9 million was repaid in early February. As we can see, there's a number of loans maturing in April, and that has been a decision that we have been very comfortable with and made. That loan in February, those loans in February that matured were extended into April as well. So we'll talk about what we're going to do with that. So the weighted average cost of debt at the end of January was just over 4%, and we expect that to that sort of cost of debt to be maintained given where markets are now and what we've already got on the book for for the next few years. So there's the implied debt. This is based on the historical annual plan. So South Wairarapa debt was projected to be 40.5 million at the end on 30 June. So that shows, that there'd be some hedging that is required. But of course, the council is going through a long-term PAM process now, so we'll have updated debt projections, and and as debt increases over time, we will have a real position. But that's just a sort of a place and time of what it was expected to be in June, but we will have harder numbers around June when we get closer to it, obviously. So in relation to what's been going on, so we've set the debt book up for a fall in interest rates, and over the last year or so we've been borrowing short term. Our view being that the Reserve Bank would take the cash rate down to at least 3.5% and possibly lower. And this would see long-term rates fall from previous levels, which is what's happened. The Reserve Bank, they cut the cash rate by 50 basis points at their last meeting a week or so ago, and they now expect their projections show the cash rate going to sort of 3%, but it's going to happen quicker. So they're now projecting that the cash rate will be say 3.25 by they'll cut again in April, either 25 or 50, so that'll take it down to 3.50. We think they'll do 25, and another one in May is projected, so that'll take it down to 3.25, and then we think another one from 3.25 to 3 in the second half of this year will become increasingly data dependent, but the market and the Reserve Bank expect the cash rate to settle at that 3 to 3.25 area. Of course, if we have a global meltdown or trade wars or a recession or something like that, the cash rate could go lower. It's not our core view. We think that 3.25 to 3 is probably the bottom of the cycle. There's some inflationary pressures still in the system. But of course, as I said, any black swan events we think would see rates lower, not higher. So we at this stage we're battling to see scenarios where there'd be a surprise increase in interest rates over the next few years. So we're comfortable with a move down towards at least 3.25 by the cash rate, and we're comfortable that any surprises will actually be lower, not higher. But from a term rate point of view, longer term rates have actually gone up. The US 10-year bond yield went up from 3.8% to 4.8% over the last 6 months. It's currently fallen back, and it's back around that 4.3% area. The main reason for that is that one, US data has been stronger than expected. The US economy is still performing pretty well. Recent data's got the wobbles a little bit, but still looking, it's still performing better than most economies in the world. And there's also concerns around the inflation impact of tariffs and also the tax cuts that the Trump administration are going to continue with. So there's a couple of reasons why those US long-term rates are higher. And at the end of the day, we compete internationally at the long end of the market to borrow from the global financial markets. And if US term yields go up, ours have to. So that's one of the reasons why our 5-year swap rate has got down to about 3.5%, which anticipates a cash rate of 3 to 3 and 325, and hasn't gone any lower. So it's not going lower because it's already priced in where it thinks the OCR is going to bottom out, and of course it has some support from those US moves, because we can't get too much lower than the US, because at the end of the day, New Zealand's a rather large net borrower. The government's a large borrower, the LGFA is a borrower. We are a large borrowing nation, so it's hard for us to have those longer term interest rates, which are globally set too far out of line, whereas our short-term rates are totally set by the Reserve Bank. So at this stage, the economy is recovering, but we don't think it's enough to stop the Reserve Bank continuing to cut. The export sector's having quite a good time of it, as is the tourism sector, and the low exchange rate. The Kiwi dollar's down near 20-year lows. It's bounced a little bit, but it's very weak, at least on an historical basis, which is significant benefit to the export sector. That's one of the reasons why the dairy payout will be above $10 this year, and it's very, very helpful for tourists, especially from the US and Europe. We're very cheap at the moment, especially for those Americans. Hopefully they're buying a lot of Martin Rapino and taking it back with them. But the export sector is a bright spot in the tourism sector, but we still have a very fragile domestic housing market, and that's lower mortgage rates aren't seeing the usual stimulus, which I think in the long term is a good thing for New Zealand. Hopefully we're not going to have another housing-led boom, which actually doesn't lead to a boom, it just leads to a bust down the track. But household budgets are still squeezed because we've got higher still. While inflation, the rate of inflation is slowing, prices aren't falling. So your insurance bill's going up by 2%, say, or 5% rather than 10% or 20%. Your rates are going up by 5 rather than 10 or 15, say, in some places. And other charges are going up less than they were, but prices are still going up. So we're not seeing prices fall. So all that mortgage cuts are really, and wage growth has fallen back sharply because we've had unemployment increasing with the economy slowing, and clearly in the Wellington area there's been a massive job losses through the public sector. So what that means is that the lower mortgage rates are just helping households pay the bills without as much financial distress as they were having a year ago. And the flip side is a lot of people who haven't got a mortgage, who had money on deposit that were earning 6.5% are now earning 4.5%. So that takes, or 4% or 3%. So that takes money out of the system as well. So it's a double-edged sword, lower interest rate. So while we think the export market, as I said, is very, very positive, it's helping the economy turn back from the recession we saw last year. We certainly don't see a boom because of lower interest rates at this stage. It's just stopping us from falling further. So we think the recovery this year will be pretty average. We may see a bit of a better recovery in 26. We've got that background of large fiscal deficits from the government. So stimulus from the government is a bit sort of hampered by their inability to borrow too much more. Next year is an election year, so all bets are off. Who knows what promises will be made next year to try and retain power or get into power. But that's next year's story. But certainly the fiscal pulse from central government is going to be relatively low over the next 12 months, we would suspect. So the economy, we're out of recession. We're not declining anymore, but we're certainly not expecting any kind of boom. And just quickly, so the Reserve Bank in November was talking the cash rate down to say 3. as you can see in February, they're saying it's going to happen quite a lot quicker. So that they're going to get the cash rate down to where they think it should be, which is their neutral rate is between 2.5 and 3. So they get it down to 3, which is about neutral. They're expecting to do that quite quickly. So, you know, and we can't see any reason why they won't cut in April and probably May. So we'll have a cash rate of 3.25 by May. There's some debate about where the bottom is. We've got BNZ saying it's going to go to 2.75. We've got ANZ saying 3. We've got ASB and the other guys saying maybe 3.25, and then Westpac are saying, well, they're going to start having to raise, you know, early 26 because things are going to get away on them. We think that's a bit of a left field view. We think the cash rate, when it gets to its bottom, and we think 3 to 3.25 is probably the bottom, it'll stay there for probably, you know, a year or so. We think we don't see enough in the future to cause the Reserve Bank to have to aggressively reverse these cuts anytime soon. And the risk is that if things deteriorate globally, they may have to either stay lower longer or even cut again. But what this means for term rates, this is a 2-year rate. This is the base rate. So when you borrow through the LGFA, the base rate is the swap rate, and then the LGFA margin is added, and that gives you the rate that you pay. So the LGFA pays a margin over the market identified rate. Currently about this is probably about 40 basis points. So if the 2-year swap rate's at 3.25, the LGFA will borrow around about 3.60, 3.70 for the same term, and then you borrow off the LGFA and you pay your margin on top of that. But as you can see, this year it's back down to below 3.50 again, but it's battling to get much below 3.25, and that's because it's already priced in a cash. At 3.25, it's pricing in a cash rate of between 3 and 3.25. So unless the cash rate's going to have another leg down, there's not much downside in this swap rate. You know, it's sort of done its hard work. So borrowing for 2 years is going to have a base rate of about 3.25, and that's why the banks, when they're offering these 2-year fixed rate mortgages now for, you know, for households, their base cost of funds is 3.25. So if they want a sort of 2% margin, that implies 5.25. If they squeeze their margin, they can get under 5. They can do those high 4s. But really, you're not going to see those rates too much lower because it's, you know, it's pricing in the cash rate. If we look at the 5-year rate, as you can see, so back in June 24, the floating rate, which is the black line at the top, that was at 5.50, and the 5-year swap rate was at 4.50. Now, it started to quite aggressively anticipate rate cuts and fell from 4.50 down to 3.50 by September last year. The cash rate had only fallen to 5. The cash rate's gone all the way from 5 now to 3.75, and the 5-year rate has actually just been trading between 3.50 and 3.90 for the last, you know. So again, a 5-year bond rate, but around 3.50 prices in a cash rate of 3-ish, and because of those increases in the US bond yield, it's snuck up a little bit. So it just goes to show that the yield curve in New Zealand, the lower rates are now all being seen at the very short end of the curve, you know, because that's what happens, because long-term rates preempt, they're forward-looking, whereas the short-term rates are just totally impacted on what the Reserve Bank does. So that's sort of the basis for what we're looking at doing, you know, for hedging for you guys, and what term we borrow for from the LGFA going forward to meet policy compliance. Quickly, yield curve. So a year ago, cash rate net 5, short-term rates 5.75, long-term rates close to 5. Today, short-term rates around 3.50, long-term rates around 4-ish. And as you can see, those long-term rates 6 months ago and 3 months and 12 months ago, 1 month ago, was slightly lower than they are now. So the curve is just normalizing. So what a normal yield curve, you have lower short-term rates should be lower than long-term rates, because you should be if you would give somebody money for a day at 3.5, the risk is only for 24 hours. If you give it to them for 10 years, you in theory you want to be recompensed for that extra risk. So the term theory tells us that long-term rates, all things being equal, should be higher than short-term rates, and it conceptually makes sense. But when the markets are expecting the short-term rates to fall, the yield curve does this thing and has a negative slope, And then as the rates get to the bottom, it normalises again. So we've now got a normal yield curve in New Zealand, and that's where long-term rates are a bit higher than short-term rates. And, that is what's to be expected. Just to sort of make sure we don't get too carried away with Reserve Bank forecasts and think that what they say is gospel. So the blue line is the actual cash rate, and those orange ones are the projections at a point in time. So if we go back here, in 2004, the cash rate was around 5, and the Reserve Bank was expecting slight increases. It actually increased by 5%. Back in 2008, when the global financial crisis started, the Reserve Bank was projecting that the cash rate was going to have to fall from 8 by 2010 down to about 7, was actually at 2. And then when it got to the bottom, they were saying, oh, we're going to have to tighten again. So they were expecting the cash rate to go from 2 to 5 by 2012. Well, we didn't change for actually 5 years. So totally overestimated the increases required and overestimate cuts. At the moment, what they've been projecting has been pretty close to what's happening. But as you can see, their tightening cycle was so aggressive that we're sort of catching up. But it just shows that, while RBNZ forecasts are interesting, their correlation with what really happens is not great. So we've got to take account to what they're saying, but actually row our own course, so to speak. So that's it really. So just to quickly sum up, so your position for this fall in interest rates, we've got significant debt maturities in April, which we can play with and we can term out. We can borrow short, we can borrow medium, we can borrow long as a mixture to give us our best cost of funds. And as debt increases, with interest rates expected to stay low for a while yet, you're pretty well placed to, put in place core debt with a all-up cost of funds with in the low 4s. So we're pretty comfortable that, the council's really well placed from a debt cost point of view over the next few years, that's for sure.
So Charlie, when does that sort of normalised fixed position come into play? You're saying transition, take its adoption down to.
Yeah, absolutely. So by the end of this financial year, we'll be in that normalised position because we've got one more lot of term deposits due to mature between now and then.
Yep.
And obviously we do our main round of borrowing in the April-May time for any capital program. And we only borrow for the capital program that we've had actually exist. We don't preemptively borrow for budgets, as I'm aware some councils do things. So yeah,
there has been some pre-funding.
Yes, absolutely. So now we borrow for what we have actually spent, which is that capital doability issues that we were talking about is the prudent positions. Yeah.
Good. Any other questions, particularly get on my mind, and I don't come control that.
Yeah.
Anybody else? Okay.
Thanks, Phil.
Well, that's really helpful. What time of day did you say it was?
It's about 7:10. So just about to go for a walk on the beach and have a bit of breakfast. So it's all very good. It's perfect timing, actually.
Don't do it too much, mate.
No, I mean, I'm as you can see, Bancorp, we're pretty comfortable with remote working, unlike Mr. Luxon, who wants everybody back in Wellington, or Mr. Trump, who wants everybody back. We still think there's got to be some flexibility.
Thank you for your time, Roy. We appreciate that, mate.
Okay. Good to talk to everybody. Take care. Bye.
Thank you.
Bye.
Okay, Phil had a bit of a shirt on the top and the board shorts on underneath.
Oh, that's good. Yeah, for COVID, we all had a shirt on. Sure, there we go.
So that's a good explanation from Earl. He has the data that backs up our position, and our move to working with Bancorp as a partner has really given us that. Whereas it would be fair to say we were working on an informed gut position beforehand. So it's really good to work with a trusted partner on that.
Well, yes, the thing that interested me about that was really about the probably the table at the top, page 35. I think of page 35 of that agenda, which had the maturity spread of our principal, and actually
what was the strategy? And I mean, just what I'm looking for, importantly, at the, not a fixed position, but the position we start to bring out, get a sense of what our core debt is, get ourselves in the bands for fixed versus floating, and we start to look in a more normal position, which would be okay.
And if you look, a lot of our borrowing is coming up in the next sort of 18 months or so.
That's right.
And actually, I'm really glad that it is, and rather than the last couple of years,
Yes.
because we will be able to get much better rates than we would have done over the last.
I think it's fair to say just being in a relatively unhedged position generally around the country because we're waiting for that rate to come down. We can't afford everybody who's going through. We're there now to be able to then take that position, particularly if we're going to use interest rate swaps to fix our position. Okay, good. Radio.
So just going quickly back to rates, outstanding and arrears, the table on the left-hand page, so that shows total rates outstanding, the blue being December 23 and the orange being December 24. It does look kind of alarming from that table. We did our approach to the mortgage, to the banks for mortgage arrears later than we usually do. We normally send that off and get that back in November. So therefore, people who were rates outstanding normally would have had their bank pay us for their outstanding if they had a mortgage on the property before December. This year we had to push that back. Mostly from a resourcing issue, we didn't have the capacity to do that before Christmas. So I've just checked with the rates officer. When we did the first notifications, we had 88 properties that we were going to send to mortgage with a total of 247,000 outstanding arrears rates. If you only sent to mortgage on your arrears. By the time we actually sent the final demands, there was only 40 properties. 48 of those properties had decided to make payments, which I think is a really good position. It's encouraging.
What's that, 40?
So we went with 40 instead of 88, and the total of 147k. So we'd knocked $100,000 off of our arrears, which is from a cash position really encouraging, and suggests that where we were in COVID, where people were just saying, "Nah, just put it on my mortgage. I can't pay it."
Yeah.
People are actually just delaying maybe when they pay, and then when there are consequences, actually coming to the table with the cash. So
we're getting penalties at the same time.
yes, we absolutely do put
So
penalties on
Do
those.
we differentiate? I guess we've got what we collect in penalties as against what we actually collect in.
We're very close to budget on penalties.
Okay.
So and we're very I don't know if generous is the right word, but we are on the side of generosity in terms of when people come to us with circumstances.
Yeah.
We're willing to talk about remittance of penalties as long as the core rates outstanding is paid. And as I've said, every time I've spoken to you since I've been here, we encourage you to encourage our communities to get in touch. If anyone is struggling to pay, please tell them to get in touch with us. We're very, very friendly, very, very accommodating, and we enter into payment plans. We'd rather see something coming in than people struggling and not contacting us.
So thanks for that.
I've heard very good comments back on your responses, but could I just get in terms of this definition, where you've got 46 with mortgage final demands, so is that at the stage that we was on the properties, or was that way before that?
No, mortgage final demands is where we confirm with the bank that we do want to put money on, put the arrears on their mortgage effectively. I mean, that's effectively what happens, but reality what happens is the bank pays us for the outstanding amount and for the arrears amount, and the bank then puts it onto the mortgage. Then that person is going to be paying the interest on that extra amount that's gone on their mortgage. But some people do treat that almost as a method that they pay their arrears for the rate.
Like a reverse mortgage for the council.
The only thing I'd say in that space is it's not always the mortgage that the bank will go for. They they take, due to the small print on the mortgage agreements, they may have different avenues for taking money out of bank accounts. Even we've had that in the past where
Oh, I
they've
see.
actually taken it direct from a bank account as opposed to putting it on the mortgage. So, whilst we activate it through the mortgage demand process, it's up to the bank how they deal with it.
Yeah,
So
yeah.
if ever that anyone came to you that said, we've activated the mortgage process, but the bank has done this, they need to go and talk to their bank.
Yeah, good point.
So through Chair, with rates income being below budget, is that largely because of this, or is it rates remissions that are increasing?
Remissions increase from budgeted a slight increase in remissions, but
Just the sort of,
due to the service, it did increase. So we have been keeping an eye on that position, and depending on what comes out of consultation with the definition of SERPs, we will budget appropriately for that. So, yeah, so generally, we do have generally a low proportion of rates outstanding and rates arrears.
Just a quick question on those that don't have mortgages. What actions do we take? Do we put those through Bake or for?
We send a legal letter, a legal
Yeah.
demand. We don't tend to find much success with people like Debtworks.
Right.
That's our provider. We tend to send a letter from a solicitor instead, and that's a lower cost and a better way for us.
Recovery.
It tends to get people to contact us, which is what we're trying to get them to do anyway.
Yeah.
So, I mean, ultimately, we can go the route of rating sale, but that's the last thing that we and the ratepayer want.
Yeah.
Councillor Bossy, what you were talking about earlier to me is that those absentee overseas owners, that tends to be the circumstances that you would proceed to.
Very good.
Thank you.
Thanks, sir.
Perhaps just to finalise the, sorry, so I thought it was, I thought I might have spoken out. So I wonder if I could just round out this page that we can discuss page 25, please. I'm always conscious we're halfway through the year, what have you got a forecast here? I just wondered if there was any comment you wanted to make, like, and I tend to look at the operating surplus deficit line, Charlie. So if we're on page 25, that says we had a budget of a $2.2 million operating surplus, and we're forecasting a $1.3 million surplus. So roughly $1 million down, but that feels not too bad.
Not too bad, and the majority reason for that is that of those emergency works, you don't get all of it funded. So you have the extra expense at 100%, and you might get 75% of that, depending on the agreed subsidy. So you always are in a slightly worse position. And then with the planning and regulatory, we have no way of clawing that back. It's extra expense. So,
So I think that's really important for us as a committee as we think about our finances. This is actually where we at relative to our financial strategy. And good to, and it will never be what we plan. It's almost, that's the rule of living, isn't it? But to know the reasons why it become. So to understand that actually majority of this is actually stuff that you can't quite recover from actually yes, to an extent unexpected costs. Although that might come back to us when we look at our climate change risk. Okay, so just I'm only trying to connect an overall financial position that actually is our risk profile, and I'd love to come back to that and see how risky we want to be. Okay, that's great. Thank you for that. Any other final questions so close race? No, well, I'm going to go to the resolution, please.
We've got chaos.
Okay, sorry.
So we have a couple of large debtors with relation to the planning space. Those are largely, we have invoiced customers that aren't actually expecting payment until the certification of the consent, from what I understand, Russell. Russell and I have been working on this and are proposing a change of process in terms of we won't actually raise the revenue until we're actually expecting it to be paid, and we will send out pro forma invoices instead. So we're just working through that process and how it works now. So,
It makes sense. Thank you.
That meets our accounting principles, but You probably thought that one.
Revenue is recognised when it's expected.
Otherwise,
Or
you've got
whether,
other months.
whether an obligation or a.
Yeah,
Yeah, yeah.
there may be some staged invoicing and put in there as a sort of partway process between that.
Yes, yeah. Okay, cool. Sorry, I kept trying to cut you off. Okay, was there any other questions you had?
No,
Okay.
I'm happy now, thank you.
Good, good. Can we move then to the recommendations on page 23, which is we received Charlie's report. We, actually, notice what do we resolve? We note there's no significant tax risks.
That's on our agreed terms of what we will report to you. So once a year, I put in a more detailed tax summary of where we're at.
Rather than just leave it to the, we're not talking tax on this side. I can't know if I conclude off this. I don't assume it. I was wondering why we needed to have it.
Okay.
Okay, so why, to be honest, I don't think we need to have to. I'm comfortable that we get an annual compliance statement around tax and position, but it's tax is not simple. So it's good to have that eventually. Right, so the motion is that we receive, it seems I've changed it. Good, thank you, Kay. Any discussion? All those in favour, please say aye. Aye. Those against, it's carried. Very much. Right, the risk management update. Amy and Paul, in your hands. Thank you. This is getting to be.
Thank you, Mr. Chair. I'll take the report as read. The risk report actually comes in two parts. So we've got the risk report itself, which I'll cover off, and then there's the legislative compliance update, which is part of these appendices. But just on the risk, on the first instance, key changes to the register this quarter, cultural risks in terms of alignment with the risk framework, obviously timely for this alignment's timely in terms of our long-term plan and local water done well engagement. Financial accountability, we've changed it from reputational risk to operational risk. Swimming pool audits, there was clear, there seems to be clear happiness, a level of happiness from this table at the last meeting to remove swimming pool audits because you were comfortable in where this is sat, so that has been removed. Critical asset failure is still to be updated. There's some work on treatment plans in terms of our infrastructure strategy. Again, the infrastructure strategy has been updated as a result of the work on the LTP, so that will need to be updated still. And economic uncertainty was economic shock, which obviously has more of an influence around sudden impact. And I think at a point in time that was highly relevant because of, well, a range of different things. But what we've done here is to change it to economic uncertainty. And with the thinking behind that is that we're very aware of the global economic impacts of the political environment and the impact that it might have on our own operating environment. So that the word uncertainty tended to be more, we felt, reflective of the intent behind the risk. Note also that the treatment plans have been updated for SR3, which is crisis management and response. Since last report, SR4, financial accountability. So there's been more information put in there, and SR10, which is health and safety. There's no significant changes to the high levels of residual risks, which indicates the current volatility within the environment. In terms, well, actually, maybe I'll pause there, Mr. Chair, before we go into any more detail, because before we
may get to the detail, but that's really good. So diagram wise, these words. So, for me, it does. I'm one of those. I think I already see one of those people that diagram
visual. Yep.
Page 38, top 39. We have the two different ways in which you've just recast our risk.
The risks. Yeah.
So, well, I think you raise a really good question. I think you're hinting that particularly the highs, if not even the mediums, are uncomfortable because they aren't the position that we plan to be in, or like to be in, if I can call it that way. That's one that I think committee this is a really important time for us to just raise, stop, pause and think, why are we in this position and are we happy? I must confess, I would like to go, look, I'm open to questions, particularly from the next section where you have it. And I just want, perhaps if I was just, while you're thinking about my question, committee colleagues, I just wonder if I could reflect what my thinking is here. Now, look, I chose this entirely almost at random when I was preparing. So I'm not saying this is any particular problem.
That's okay, of course.
Strategic risk number 7, which is actually, I don't know whether whether it's quite right. The thing was social license to operate on page 57.
That's,
It's our
Page 7 or
It's our 6.
it's,
6? There's a slight difference between.
Social license.
It doesn't matter. Okay. So my critical point is that he goes an expanded view on page 57 of what's on page 38.
All right.
Okay, so we've got, obviously all the detail about the description, the fact that in a unmoderated without actually doing anything for this is actually high risk. You've got a level of work that you do all the controls that we put in place that we make mean that we're more comfortable.
Yes.
Have been at medium, and the question is medium, does that meet our risk appetite? Are we comfortable with that? Then over the page, and this is brilliant stuff, you've put down actions that you are taking in relationship. So this is additional actions in relationship control. So there's 2 questions out of that. So look at my risk environment, and we're a bit red. I think also a bit uncomfortable. I then look at these and see where we're at. So just look at a couple of questions there. One is the proposed action or the actions you're taking on page 58. If completed, does that reduce the residual risk or does it retain it at the end?
On that particular risk theme, it is intended to manage the risk rather than fully control it. I'll expand on that phrase, if I may, just to kind of, because the social license to operate is an ever evolving space for councils. More pressures are put on us for all directions, government reforms, the community expectations, so on and so forth. And so what these actions are meant to do is to hold our feet to the fire, keep us mindful about the ever need to think about our social license to operate within the community. So it isn't about the spray and walk away approach. It's about do it and then think again about what else we can do in order to build that social license. Does that help?
So that really says about medium. It's keeping us up with the play, rather than doing it. So this is the real question for us as community members, and not directly Jan and the team at the moment. This is about resource allocation.
Yeah.
So Jan and the team are applying additional resource to maintain a position. And my sort of open question to you is actually, is that enough? Should it be more? Should it be less? In other words, the real question is, what's your appetite around this as a risk? And we as a committee haven't defined that well. And I don't think that's not a criticism of that committee. This actually is the launch pad. We have opened that discussion. I must confess, Amy, that probably is more a workshop that we need to have going down. And I would suggest with this sort of information, we would be ready to do that reasonably soon. But I think there is an onus on us as a committee to work with Anne and Paul and the team to agree what is our risk appetite. Because actually, at this stage, they can put this up, but they don't know whether that is meeting what we think should happen. Now, I mean, to me, by the way, out of interest, everything you're doing here makes a lot of sense. Okay, I get it. And it might be that we cannot get past medium. But the question then becomes, what do we define as medium? And we haven't necessarily quite defined it. I'm going over page 69. it's a significant consequence of that table than a risk appetite.
Mhm.
But it is actually reflecting, if we're, well, we talk about medium residual risk, and I'm not quite certain which one it fits, whether it's minor, moderate, major, or whatever. But it does say there are certain things that probably happen where at that risk setting. And the question is, for us as committee members, are you, you know, if I was to say, I'll just pull out of the head, if we're sitting at major and to say, you have, should we be spending more resource allocation to say, quite frankly, minor? Are we prepared to trade off a minor setting and be say a risk of major, but because it's being money? So we still have quite a bit of work to do here. So when I ask the question, that's a long way, 5 minutes, 10 minutes. Now going back to you guys, committee members, what are you feeling about it on page 38 of our risk and profile?
Yeah, I totally agree with you. I think we've got a lot of work to do here, and I think quite honestly we have by default got the staff to make that decision for us, and I think they've done a very good job. But yeah, I think we should have a workshop on it, because it is implications, because you look at medium risk, but then there's a whole aspect of what the resources would be take to make
Yes,
it
that's right.
low risk,
Right.
which can't afford, so it's real complicated.
It has to be a two-way discussion.
Yeah,
Because
that's right.
if we're asking for
Yeah.
allocation, Jen may well say so.
Yes.
Like,
Put the rates up 25.
So what are you going to trade off to be
Yeah.
absolutely perfect and say in the social license area? What don't we do? Which is, I think, it's very.
Yeah, it's probably a good opportunity to have a workshop on how risk averse we want to be moving forward in the future. Because when I look at some of these things here, I think perhaps that's a little extreme, or it's a little undervalued in terms of its risk analysis. And I think until you actually sit down and grind down some detail about what's acceptable and what your appetite is for risk, then I think that we're just looking at something that's been produced over a period of time. But maybe a review is necessary.
I'm not trying to.
No, I was going to say, I agree with Councillor Rolls. I think a review is definitely.
I'm not wanting to say that I actually think, I just want to perhaps just check what you said there. I actually think we are getting much better information, and we are now in a position where we can have that, we can have that conversation. Let's face it, I'm not certain some of the stuff could go below red at the moment. So if you take government reforms, it would be pretty difficult for us probably at this stage to get that below red, because actually that's an external factor in our operation, for which, I mean, our response is in our hands, but actually the need to respond in the first place is actually externally driven. We would argue it's about climate change as well, which I think we've got to keep gripping up on. We see the effects in our coastline and what have you. But so, to say it's red is perhaps with government reform is just being realistic. It is what it is. So that it's red is not a reflection on us or indeed staff about the position that we're in.
There's things you can't mitigate though.
Yeah, that's right.
You can't,
That's right.
you can't mitigate the risk of reform because every government. So what you have to do, of course, is adapt.
Yeah.
And how you adapt, is that a risk, or do you put the necessary resources into adapt? Yeah, so.
There's a same, and there's some regional alignment as well. You just can't control what's happening.
No.
I think that's going to be valuable in a workshop setting to just to think these through with that. So the equivalent, well, not the equivalent, the actual page 57s of this world, so that we can. I mean, without making it us and then Paul thinks that's the right place to be. I'm just.
So I know exactly what you mean.
Paul needs to have the assurance from us that is the place to be.
Yeah, and I guess
we've never defined that. So
we haven't, and that's I guess this has been driven by officers effectively on their analysis and their matrix and how they come up with these. Would that be a fair assumption? So we as a committee probably haven't had the opportunity to analyse that matrix and that analysis.
Does that also come from a place of being risk averse because it may come back to haunt you, by you.
Yeah.
Therefore, you're criticised for a decision that you've made. So better to go high than go.
It isn't just a scoring based on a feeling. You know, there are factors that contribute towards that rating, and the reality is we've also got to look at them as a point in time as well. Things change, and the worst kind of risk matrices is the one that you just sit on and it sits on the hypothetical shelf for over 6 months and it never gets reviewed. As an SLT, at an operational and a strategic risk, we review them every 2 weeks. But the table's quite right. We have not had the opportunity to sit down and explore risk appetite, which is clearly needed.
I think the other thing that I would just want to leave us, I mean, I think there's some probably other things we want to talk about here because there's some other stuff sitting in here. But I would think, yes, this is about are we risk averse or are we not? But actually, the basis on which these have been identified, we have been involved with risk amplification, although largely the hard yards are falling. There's actually, we've set ourselves out to try and achieve things. These are the big bits that could stop us. So that's why we've got to focus on these. If we have critical asset value, we're not going to be delivering the services.
Precisely. Yeah.
So it's in light of actually what we want to achieve that we then start to think, well, these are obviously the things we need to govern and manage. The question is how much resource do we put into it? And that's going to be governed by how prepared are you to push this.
There's also, and there are, just an assurance, there are 2 levels of risk management that's occurring here. As I said just a moment ago, as an SLT, we look at our operational risk every fortnight and to make sure that they still reflect our own risk appetite and our own sense of what's going on at an operational level. And at one point in time, I think more towards the beginning of the triennium, the risk list was a blend of strategic and operational. And so this is a really now been collapsed right down. So all that you're seeing here are the ones that the big gnarly issues that this table needs to be considering.
Yes,
Chris, just a quick question, because the reality is that we don't have a lot of oversight of risk. That's an organisational, operational matter, and this committee would accept effectively what's produced to us. So I'm not sure what benefits we could have in saying as a council and a governance body what appetite we would have for risk in terms of giving that direction to operational staff. You see where I'm coming from? It may sound a little confusing, but to me, they're able to assess that on a daily basis far better than we can, coming in once every 6 weeks.
Yeah, look, here's the point. I think what I'm wanting to reflect is I did actually speak through to Amy a table that I find useful for governors to define their risk appetite. I don't think we'll share around at this stage, Amy. I think we'll save that for a workshop. I agree with you. That's good governance, is actually you've got management on hard yards.
Yeah.
Okay.
Yeah.
But that doesn't. I don't think that should stop us, Colin, from having that setting where we can have that discussion where we can agree. I mean, the critical thing about defining our risk appetite is, if we have seen an opportunity, we've got the risks associated with it under control, and because we've got the right controls and nothing's cropped up that says it's okay. Well, yeah, we just want to let that operation go for a team. Make hay, don't come back because you don't need to. It's all under control. We want to see the things that are the exceptions or big. So the only way that, in some sense, you can find it is when it gets out of appetite. Because good risk management is essentially you manage a matter at the last competent level. But if it gets too big an issue, it's got to start escalating.
Yeah.
So, I mean, that's why, for instance, here we've got two direct operational risks as defined by Paul and T. IT system failure and critical asset failure.
Mm.
They are highly operational in nature, but actually they are, by their definition, and indeed even their grading ones, that clearly are, when you're in the asset failure one, if we should be hearing about that, which we are, which is brilliant.
And I would just flag one further point. The titles of these risk themes don't always relate to the how can I word this? Don't always relate to the tangible risks. So, for example, I'll expand on that. If I think about social license to operate, one of the more governance level direction setting conversations that needs to be had is around asset retention, for example. Now, that is not an operational decision. We would seek your direction on that. However, the implications of any decision that you make at the council table impacts upon your social license to operate and all of these other things. So not everything is hardwired to a direct risk, you know, so I just wanted to flag that there are very significant governance level conversations that impact upon operational issues and vice versa.
Not everything's a cost benefit analysis, right?
If I could just add though, well, there's more work to do here, but I'd like to say just when I first saw this risk register when I started on council, it was about 200 times as long as us. And little items like dead leaves accruing around the swimming pool, I guess. So this has been, you know, just improved. And
Be good if dead leaves accruing around the swimming pool. Actually, we should that day. I think I might have believed
that was one that was discussed, and many others of that degree of trivia. Yeah.
That's down to the immense work that Amy's put into it over the triennium as well. So I think she needs to take a huge amount of credit for that work.
Very so.
True.
Just like I make a comment when I read through analysis like this, it gives me confidence effectively that that management and operational people are identifying these things that could cause us some grief in the future. They're well aware of the risks associated to the matter in hand, whether it's even a reputational risk, and long before it ever comes to governance in terms of have to deal with it. So I think the way it's managed and the way it's presented to us is actually very beneficial.
I think that comes down to our purpose, doesn't it, Councillor? We're an enabler for good decision making.
Yeah, absolutely.
So, would you like me to continue, Mr. Chair?
question around stuff like, you know, you go to the, doesn't matter which table, I'm looking at the one on 39. So, you know, really, I've just got us, we're the principal people I'm sensing are comfortable with big management are doing around these. Is there any particular risk at this moment that you need guidance on from the committee? We haven't defined audit risk, I get, audit risk appetite, I get that. At this stage, is there anything that you and management need from that fortnightly crawl through the operational risks that would be helpful for us to discuss today and have guidance?
I think there are a number of areas that cut right across a lot of these strategic risks that if we drill down further, we could have some really good direction setting. And one such example, if we look at climate change, for example, and there's a lot of governance decisions around divestment of roading, coastal retreat policy, all of these various issues that would actually help us understand what we need to resource as part of our forward work plan. And I don't mean to beat around the bush on your question, but I think you could look at any one of these and find something that would need further investigation.
Through the chair, I think the first step is to have the risk appetite conversation, because the risk appetite may be different for different things. So you may have a higher tolerance than a lower tolerance. I think once we've understood that, then we can review this and then we can do the deep dives on individual risks. And that might be that when we have Bruce here, that we have the meeting and a workshop on a particular, and that's what we did before. Yeah. In a previous world up north, was we would have a deep dive on one particular risk, and that's when you would have those more detailed conversations. it's such a really big topic that having
Mm,
that kind of conversation in this kind of meeting would take all of the meeting.
Yeah.
But we do need to keep bringing this to the table and having your guidance as to where we go with these. We know operationally where we are, but Bruce is right. If you want to focus more effort on a particular outcome or risk mitigation, we need to see how that sits in our current plans and resources.
It feels like a couple of very helpful ones. Probably we do need a workshop just to get going on the risk appetite. But maybe perhaps you and I should be. We had
Chair Russell is.
Russ.
Mr. Chair, just endorse your exploration of the topic and the merit of it. My comments would be around the value of a timely point around the value of a workshop on the points of an opportunity to refresh, ability to explore the topic in its entirety, to build clarity and to build that consensus between governance and managers. So I think your point, right, has those kind of points attached to it.
Thank you. That's much more nuanced, a little better expressed than I was doing. So thank you, Russell. Appreciate that. Probably to some extent I've dealt with treatment plans, Paul, but at this point, again, unless there's something you want to raise, so perhaps we're on the legislative.
would you like me to go into the legislative compliance matter? So, I mean, broadly, the first 2 pages are, so page 71, 72, lots of positive things for the regulatory space. Things are on track. I think if there's any, Russell, is there anything deeper you'd like to delve into of any substance now? I will highlight items 6, 7 and 8.
What page?
73. Sorry. So the reason why I'd like to flag these is because of the journey that we're on over the coming months towards LTP. As happens most years, we start to see quite a stark increase in numbers of LGOIMAs around types of information, around rating. So lots of finance related questions that flow through. I look at the numbers there, 112 recorded LGOIMA requests. Amy manages our LGOIMA process, and whilst our requests are within 100% of timeframes, which is a very good message because it requires the input of all business units. It is really a flag that I'm just putting out there as something which is likely to be increasing on the months through to LTP adoption, particularly around the consultation process. So that's the first thing. The second thing is a good signal. Despite 112 requests, we've had no ombudsman investigations or interactions. So we're asking questions in a complete and timely fashion. And the final one, we did have one privacy breach between July of last year and January of this year. It didn't reach the threshold. In fact, it was fairly recent. And I don't think I need to go into any further detail because of the fact that it didn't meet the threshold, but it was something that was managed accordingly.
Ask, on the terms of the total requests recorded, would you have the number of requests or requestees? I mean, how many people have done 112 requests this year?
It is something we've kept in previous, so we'll look at unique requests versus, so where we've had the same person making multiple requests.
Yeah, that's right.
Yes, because
there's quite an interesting distribution.
Yeah, I would have to delve that with Amy. But so it's clearly not something we can answer today. But we have had in the last couple of years a pattern of individuals making many requests, and many thousands of staff time dollars being spent on individuals. But it is we have also adopted a much more transparent, or we feel is much more transparent approach towards Lagoima releases. We did have a period of time where we were selecting what we needed to release, and so I'm now working with Amy to give a green light to those types of things that we can put out there in the public domain to shortcut any opportunity or any prospect, sorry, of someone asking the same question. You know, we can just point them towards the answer. So that kind of thing does help our social license, but also helps with, you know, us being wanting to be transparent as well.
Could you charge those vexatious twisties?
Yeah, you're allowed so many free and then you have to.
We are somewhat limited by the legislation as to what we can do, but we do consider it, I assure you. Yeah.
So dear Amy, the person does the hard yards, Amy.
Through your chair, at a glance, I could say it's less than 10 people that are frequently asking requests, and we're talking more than 5.
Yeah, gosh, yeah.
per person. Some have over 10 and some years. So,
Yeah,
but yeah,
gosh,
I can produce some figures for the next one.
yeah, I guess accepting that doesn't make matter.
Think of that. Colin.
I just want to make an observation because some years ago, when Lagoima requests first started coming in, we used to actually name who the requestee was and also the subject material which was available in the public document. Is that, I guess that's a breach of privacy now, or seen as a breach of privacy rather than naming individual?
Yeah, we do redact. Yeah.
With what, sorry?
You redact the person's name and their contact.
Yeah, well, it used to be in our.
Legally, privacy.
Yeah, privacy.
Not for media requests.
No, but it used to be in it.
For significant bodies like university research and things like that. We
Oh.
do that.
Yeah,
Yeah.
we used to get perhaps 1 or 2 a year, but we said we.
I wonder, I'm comfortable with the level of disclosure we have here. Look, if it doesn't take too much, you could meet.
But I think
A very
it's
interesting
right.
question from Kay about the number that's fine. I don't know if we need to have a table. In some of my committees, I see those tables of PX, actually probably both PX and public, but obviously in public protected. To be honest, from a governance perspective, I'm not entirely certain what the value of that is, other than, well, that's interesting, that person's doing that. I would be interested if there is a pattern type of information or particular request which is showing me in a meeting and not we aren't meeting, but it is requiring requests to come in. In other words, what are we learning from the nature of the requests rather than who? So if that was relevant at any stage, Amy, I'd encourage you on board to raise that with us as a committee, as in contrast to necessarily the default of each individual.
Yeah.
I'd welcome that. One question from me, you're obviously warning and anticipating requests coming in the coming 3 to 4 months.
Yeah.
What's the strategy to deal with it? What's the plan?
Well, we've, the LTP project team has sat down and as we did with previous annual plans and taken a triaging approach, identify those things which are clearly LTP specific and wanting to show that we're being responsive, updating our Q&A sheets that we make public, that we can point people towards, that type of thing. Anything that falls outside of the LTP, we need to really consider how it fits into the Lagoima timeline. We want to be responsive, of course we do, but when we've got one person coordinating council's efforts and everybody being diverted in the various spaces, it can be a little bit of a challenge, but yeah.
In effect, you're anticipating an increase. You're looking to see if basically LTP, can you deal with the LTP project?
Yeah.
As in contrast to it just becoming.
Correct. Yeah.
Through.
Yeah.
That makes a lot of sense. Thank you. I wonder if we can keep going, please, Paul. I think on pages 74 and 75.
Yeah, so these are just the waters, so water compliance. Stefan.
It's just
Very convenient.
The only thing I would say here is we have had part of the process we've just been through for the underlying documents for the audit, we've been through some of these targets because we have inherited targets this year that were in the existing DP. And in some cases, the targets are so out of reach that we were never ever going to reach them.
Yeah.
So we have had a good look at whether they're realistic and spoken to our advisors about what appropriate targets are, because some of these that are set at 80-90% are never going to get there. There would be step changes to get there. So.
And further to that, and more broadly, at the just remind members that the November Strategy Working Committee meeting, council elected to adopt a new balanced scorecard approach towards performance management. And whilst the LTP has KPIs which I'm pleased don't form any of the the conversations that we're actually having, the actual broader performance management framework will include all of the things that you're seeing here in terms of legislative compliance, as well as internal customer experience measures that were being implemented across the various delivery teams. So whilst, and that will be done from the start of the long-term plan, the new annual plan period, year 2 of the long-term plan. So it's a much more mature approach than what you're seeing at the moment.
Stage, the current report, the last quarter reported the majority of the measures that tend to be response times. Which is all clearly a very real sense of procedure that tends to sit. I noticed the really big one you pulled right back, so there must be something there that be correct, which is great. Okay, brilliant. Well, that's fine. Thank you for that follow-up. It's important we see that. It does back through. Anything else that would like to raise as a question?
No.
Very helpful risk. We've got a few things to do to plan and organise out of that, which would be really great. Thank you for the discussion. The resolution is
An information paper.
an information paper. So, sorry, don't have resolution. Oh, mate. Sorry. Councillor. So thank you. Appreciate that. Okay, so second information paper, if I recall correctly, is indeed our people report. Must get Paul Wilson what I'm talking.
Well, I'm actually going to give the opportunity for various members of my group to come in and speak to the papers, give them exposure to your good selves. So I'd like to introduce May Griffiths. She's our lead advisor, people and culture. So I'll let May produce the report.
Hi, welcome to the meeting. I'm probably the only one who don't know. I'm Bruce Robertson, so welcome.
Hi.
I think hopefully we're not McPherson, so exposure is hard word. So welcome. We'll look forward to what you've got to say.
Thank you. The brief itself, first off, I'll take it as the report has been read, Mr. Chair. Brief itself, the people risk register, which you see there, has not changed from last time. So there's no changes in there. And the second part of the report, the dashboard, there has been a couple of new graphs which have been included in there, which I wanted to bring to your attention. So if you refer to page 84, what I've included is a full-time equivalent graph. So full-time equivalent is 37.5 hours a week. So that is in addition to, on the page prior, we've got the employee count. So what I've done here is kind of broke it down a little bit. So I've taken it back to August, but broken it down a little bit in terms of which roles are externally funded, and then also broken down the Wairarapa Library Services and the roading function as well. Also on there, you'll see there's a line which is drawn across the top, and that's kind of where our funding was set at the start of the financial year. So, and you'll see we're quite close to that at the minute as well.
Sorry, what page was that line?
Sorry, that is page 84.
Thank you.
Yeah.
Oh, I see, yeah, yep.
This is really helpful, mate. Thank you very much. It's good to read.
Yes. Used to get, so ratepayers used to get very confused about part-time staff and full-time staff. and stuff.
Absolutely, yeah.
Funded it.
So there is obviously clearly there's a difference between, and the word, the acronym FTE gets thrown around an awful lot. And people don't always understand what it actually means, yeah.
Great. And the other, if I can refer you to page 86, that's a new graph that's been included as well. And this is a bit of a recruitment graph there, which shows kind of the time to fill days for some positions that we've advertised from 1 July. The red are ones which are still under recruitment action, and the blue are what has been filled. So that was recruitment action as at 11th of February. So, you know, you can see from that some of those real specialist roles take us a considerable amount of time to recruit. Typically, what you'd sort of want to aim for is around about 42 days. So, you know, some we've done quite a bit ahead of that and some have taken a lot longer.
430 days.
That role itself was, I think it was advertised about 5 times during that period. So it wasn't just back to back. But so, yeah, that just shows us from the day it was first advertised to when the offer was signed from that by the individual.
So the thing I would flag here is the importance of this chart is an understanding around this table about the impact on levels of service for the certain types of function, particularly the more technical ones. You know, because clearly we are only resourced to deliver to a certain level of service. So we, so that's why we felt it useful to include.
So made it with the asset management, did you say that's not built or it's
Which one, sorry?
management, 151 days is the red?
Oh, yes, that one is still under recruitment action and we have gone out to market a few times. We've actually just engaged also with a recruiter who kind of specialises more in shoulder tapping. So we've just engaged not long ago with that as well. So that's, I think that's probably been out about 5 times. It was first advertised.
Okay.
That's essentially 51 and counting.
Just a quick question in terms of where you have a vacancy and you need to fill that position reasonably quickly. Do we engage with a contractor to fill the gap until we've recruited somebody on a lot of occasions? Because obviously, so where they're available, you'll fill that vacancy as an interim until you recruit.
Through the chair, depends on the role. And at the moment while we are waiting to fill that role, we are taking other steps. Stefan is in his team to ready ourselves for when that person arrives, so they hit the floor running. So things like condition assessments and those kind of things, we're using the money to do that instead of the person. So whilst it's not a contracted to do the job, we are getting a lot of things done while we wait for the person to join.
I guess my concern was that somebody has to pick up the slack, obviously, as a vacancy. So that would be either loaded onto an existing staff member or
if there's a need for the role, then we will move to consultants to fill that role.
Yeah.
It depends, and everyone can be different.
Thanks, Janice.
Just if I can backtrack a little bit, the other graph to just bring to your attention on page 82, which is our total outstanding leave report, and just wanted to report that this is at the point in time. It doesn't highlight any future leave. So a lot of these people that do have really high excessive leave balances actually do have leave plans in place and leave applications submitted. So we're getting that kind of really well under control.
Through the chair, the other one I think to bring to your attention is on page 84, which is the length of service. We talk about every month that 67 of our employees are 5 years or less within the organisation, which is a risk for us in terms of that knowledge leaving the business, or staff don't know what they don't know, and if they've not been in local government for very long, then we're on a continuous learning curve. So That is a very high number to have in that bracket, so we're trying to do what we can to encourage them to stay, but also to look at the age breakdown as well, because we are very heavily stacked at the higher end of the age spectrum. So we're looking at how we can encourage or bring the younger people through into local government as well.
One of the initiatives that we're exploring at the moment is the development of an alumni. So for those individuals who have left us for whatever reason, or they've done work for us in the past, to continue to engage with them. So they may make themselves available for short spells for specific pieces of work. So really trying to think outside the box in terms of, you know, we don't always need a warm body that's fully employed for, you know, 12 months plus. We can just tap into somebody's skills and expertise for a particular thing. And that could be just on a casual basis.
Great idea.
Which would then help with that recruitment lag and
Yeah.
things like that.
Yeah.
Again, thank you for raising it. It was going to be probably my one question, man. Yes, as a person exposed to risk, I was very interested in the front section, the risk tables. And I was just wondering about the knowledge transfer goals, or even potentially whether the left-hand column is captured all the risks. But I was looking at 86 with that, with the roles that are difficult to fill, which all seem to come in the area of, broadly speaking, SEN and construction management. Which made me wonder about a risk description around being able to fill roles. Secondly, also knowledge transfer. I just wonder whether it's moderate. I don't. Again, I'm back into my, is that an acceptable risk or not? You know, at the level of moderate, that actually I just wondered whether you know how it fitted, because one of the nuances of risk management is that we have indicators of risk. Think about it. The lengthening out of the days, particularly around asset infrastructure, is an indicator, a red flag, a KPI, whatever we want to call it, that could be used to measure how we're going against some of these risks. It's a long way coming back to, you know, there's something like our knowledge transfer critical roles. We've got 67 staff that are less than 5 years. We've got trouble filling. No, I'm trying to black out the whole place, but you know, we've got problems filling roles and what have you. Do we have a real problem with a clear need, which is we've got good retention of knowledge and good transfer from between the transition phase?
I think for you, Mr. Chair, I think the larger risk is actually a sector-based one. It's a local government feeling like it's somewhat constrained by needing a warm body in the office, a traditional working environment. And I refer back to our treasurer's comments earlier on, Earl, how he's working in Thailand at the moment. Now, I'm not suggesting by any means that we employ people in Thailand. I'll be very quick to say that. But what I will say is that we do need to think very differently about how people work and whether or not they have to be physically located for, ring fence pieces of work all the time. If we have to think differently about how we engage with the future workforce. I think that goes into not only the knowledge transfer, but how we are sustainable as an organisation in terms of our future workforce.
Sorry,
we're also constrained with pay.
Yeah.
Very often the consulting firms can pay in these areas that
I've seen that, yeah.
That they can get more work from consultants and work for us, but we have been exceptionally lucky in the last 12 months and picked some incredible talent in the organisation, and hopefully they will stay with us for a while, and we'll be able to settle in those spaces. And quite a lot of them are in the room today, so I'm grateful to have them on board.
And working environment has to play into this as well, right? I mean, the fact that police officers aren't exactly the most liberous of environments to be.
Happy about
Remote, sorry?
Happy about.
Happy band, but I think remote working.
Great cafes to work from. I can say that's a personal experience there.
Yeah.
It's the thing, and I mean, we're almost on a deep dive here, which is the value of actually
perhaps trying to find the hour. And it's me trying to think about the papers that you are presenting us with May or 20 integrate. So I look at, I start with page 86 as a flag. Someone say to me, gee, what is this saying about I take your point about where the sector's at, but it's biting us. What's that doing for us, South Wairarapa, in terms of our capacity to manage our assets? I think the risk paper, we've just critical asset target. And I'm starting to say, well, wait a sec. Are we thinking appropriate? Yeah, I mean, you already give us third-party mitigation, which is actually not sitting on your thumbs here waiting for some recruiter to tap somebody mythically in Thailand will come do the work for us or whatever it is. You are doing some cover. But if I take the papers as they stand as an external, I say, hello, we can't recruit the asset and infrastructure. Raises some of our employment risk, and hello, we've got critical asset failure as a high risk. So again, committee members, I come back to what's your appetite and risk? Are we allocating the right resource dealing with these problems? We probably are. Well, I'm reasonably comforted, but I just want to try to all the connections there. How we go about it. Okay.
Can I just make a comment? Because when I see figures like 0 to 5 years and 67 new employees over that period of time, I questioned about retention of staff and what we're doing to make sure that those skilled staff are retained within the organisation. And we are competing on a global market. But you talk about appetite for risk when you've got those critical asset highly identified. As the skill mix not part of it. We need to eliminate that as much as we possibly can. But we also need that intellectual knowledge. Based in an organisation, I must admit that's a phenomenal amount of staff in that 0 to 5 years. So how much have we lost in that corporate knowledge over that period of time? So,
through the chair, that's why the creation of this alumni is so important. And don't think for 1 minute that this is just people who are approaching the end of their career who joined this group. We have had others leave for various reasons who are still in the area who would be valuable in that space. Even this week, one of our planners has left us because she's going to spend some time at home with the little one. But having her in the alumni so that we would have someone to reach out to if we had a particular technical query that Russell's team needed support on would be valuable if we had that process in place. Probably talking out of turn here, but in terms of encouraging staff to stay, we're going to be talking to SLT about recognising not high performance, but good work. I come from an environment with a few work awards, and we're figuring out how we can call out those people that are going above and beyond, which a lot of them do day in and day out. So how do we recognise those? So it's not quite reached the employee of the month picture in the campaign yet, but those kind of things to actually make people feel appreciated go a long way.
And
share those with governments too, by the way. I think often you keep things internal and we don't get to hear about them unless we ask you the question. But it's actually quite useful if you do share it.
About having elected members present when those awards happen. So
because we like to cite about our organisation too,
I must admit, I'm also a realist as well. And I am, and we know that certain individuals in certain roles don't like to feel locked down for long periods of time, and they may be in a transient kind of profession, and so it isn't always a bad indicator. When what I'm a firm believer in, if people leave us, I want them to leave us with a good taste in their mouth. I want them to come back to work for us again in the future. So there's, exiting is not always a bad thing.
No, I agree, but 67 is quite extreme.
So there's the nature of employment in these days. My longest employer has been something like 6 years. And that's just the nature of how people work and how their careers go these days.
How many years have you been here?
In 6 weeks, I'll be 5 years.
I'm being worried about one solution.
Accounting.
Best, Charlie, you don't put it as the best.
Quite risky.
When I left school,
Okay.
I was advised that the
Relationship.
jobs that you need to get are in government departments because you're there for life.
It used to be, not the
Yeah, I
case
know,
anymore.
yeah.
No, especially not recently.
Thank you. That's been very, mate, it's very helpful. Thank you for the
Yeah.
Thanks, man.
new
Much
information.
appreciated.
That you're giving us information, which is I've tried to not go into some of our total risk. Which is
Thank you.
Yeah, thank you.
forward to
Thanks, Ryan.
contribution. Thank you. Craig. Health and safety, please, and emergency management.
Yeah, well, Matt Vin's to the table. Matt, you may recall Matt's our manager of sports, so he's going to talk to this people.
There, how are you?
Hey everyone, you're right.
Your hands.
I will split this into two as the paper set out that way. So we'll talk about health and safety quickly first. There were 10 incidents internally reported across the organisation. Remediation of the mould in the toilets has now been completed and the toilet's been reopened after a period of 3 months. So that again reiterates the challenges we've been facing with our building, but are getting on top of that as much as we can. The asbestos management plan is in budget for next year and sets out how we manage our asbestos across our estate. And we had one incident pending with WorkSafe involving a contractor and an incident there. So we're awaiting feedback from that investigation. Happy to pause on health and safety or carry on to emergency management.
No, let's do the health and safety. Thank you. It'd be good to treat emergency separate items. Thank you for a very succinct and brief report. Well done. Take questions. Stage. So how did team go against previous periods?
I think it's broadly consistent from what I know. So there was nothing standout that suggested a significant jump.
Yeah. Okay. And sorry, just remind me the one that's been reported to health. Sorry, you said it's a contractor, isn't it?
Yes, involving a contractor. Yep.
Always an interesting point when combined PCBU. So
yep.
It's sort of obviously that we would just monitor at the stages really between WorkSafe and the contractor.
Absolutely, and we monitor how our contractors report incidents, making sure they're proactive with incident reporting and taking their health and safety seriously. So that's just ongoing. We'll await to see what WorkSafe come up feedback on.
Yes, it's probably too early to necessarily draw any conclusions, but I was just wondering whether as the principal to the contract, whether and obviously on the side of the combined PCBU, there were any lessons that we might have taken perhaps in the way in which we deal with contractors.
Yeah, absolutely. I think it's probably worth getting the feedback from WorkSafe, getting their verdict, and then doing that lessons learned process.
Is it likely to be a charge that will take a long time before WorkSafe and the contract complete?
Not by their history, but we'll wait to see what their verdict is. I suppose.
The other thing that interested me, sorry, I've got questions on the, by the way, I'm just having on here, not that finance, pretty interesting. We've got the psychosocial, so on page 99, which is primarily with the almost related incidences. Fortunately, it doesn't appear to be too high, but I wonder whether there was anything that you could add around that.
Yeah, so it's just if a member of the public is potentially verbally threatened or been particularly unpleasant with a member of staff, so that could be face to face, it could be over the phone or via email. So we obviously report all of those. If they're serious, if necessary, we'll report them to the police. Had an incident like that a couple of months ago, so we are on top of that. It reiterates our need to look at the security of our building and the protection of our staff and health and safety. So some of those physical improvements we're looking to do will come about and help support safety of our staff at the workplace.
And the other question I had, I think it was my last one, was again on page 99. I thought, well, internal wellbeing conversations, and I thought, tick, good. And I thought, actually, what is an internal wellbeing conversation? And if we've got 91 employees, it's one-on-one is 16 enough.
Yeah, I suspect the challenge of wellbeing is you pick it up in many different formats, through an official route, through the kind of health and safety wellbeing manager, or just through someone's direct manager in a one-to-one or anything like that. So these have been recorded that have had a particular focus on wellbeing, that it's positive that people feel comfortable in speaking about wellbeing and then potential challenge or frustration or whatever it might be in the workplace. But we can go back to the kind of previous data and see if that's consistent in terms of how many we're experiencing, and see if there's any trend in that space. But yeah, that's kind of the approach we do, where managers are very much encouraged to have those wellbeing conversations as part of one-to-ones. It's not just work; it's making sure staff feel supported, valued, and safe in the workplace as well. So whilst those wouldn't necessarily be reported at all, that's part of that kind of continued commitment to supporting staff wellbeing in the space.
Thank you. Any other questions from folk on stage? I can go on to the emergency management, please.
Yeah, absolutely. Again, take the report as read, so we'll just pick out a few key bits. So the emergency resource containers are being gifted to a number of remote communities to support those communities in an event. On the 7th of November 2024, the Wellington region exercised together for a large earthquake scenario. So that brought the three councils, the Wairarapa, together at the Masterton EOC. And then we were working across the region with all of the Wellington councils and Remo, our partners, to support and deliver emergency management response. We had, as a council, had a significant number of staff at the event, a significant increase previously, and 80% higher than any other council in the region, which emphasises Janice's commitment to ensuring that all roles which can be suitably released are as part of that emergency response. So we have the resilience across the council, which again is only good for our communities. To note, it's been the 2-year anniversary of Cyclone Gabrielle, and the recovery office is continuing in that space until around June, and continuing to process some of those recovery works. Towards the end of the report, you'll see the Wairarapa Emergency Management Annual Assessment. This is an internal assessment of how we see ourselves across emergency management, across quite a broad range of factors. It's important to benchmark this and determine key areas to focus on, and more to do, a lot of it to do with community preparedness and recognising the scale and the geography in our region. What's really good is actually the maturity over the last few years to move away from we think we're all fine, we'll give ourselves a good mark, to going, actually, this is a realistic mark. Where do we need to focus? Where do we need to put in some extra investment or be considered? So our scores were comparable across the region, which makes a lot of sense. This report will have already gone to Carterton and Masterton's similar meeting to the ARF committee, just simply because they had theirs towards the end of last year. The Wairarapa needs review, it's continuing, and we'll be focusing on understanding the region's risks and associated mitigation for those, which are some of the key areas which the assessment highlighted. And just a note around the emerging risk of space weather. So through NEMA, which is the National Emergency Management Agency, highlighting the period of heightened risk due to space weather, still, I think, mid-2027 or something similar. And this has particular risk to our communications, power and travel. So this is a relatively, it's always been there, but a risk that we recently picked up and put more thought and consideration around. But very open to any questions.
I will just build on that. The in addition to the report and a fairly recent conversation is the in addition to the what Matt was saying in terms of the risk landscape. I met with the CEs and my two counterparts in Carterton and Masterton a few weeks ago. There was a broad agreement to formalise a new emergency management office, which has already been included in budget across the three councils. Its intent is to professionalise emergency management. And so the risk landscape work is going to be one of those things that gets completed in the first 6 months of that office being stood up. So yeah, it's a very good step forward.
Yes, just going back, sorry, to page 87, sorry, going so far back. The reference to EM as elected members, right?
Emergency
Emergency
management.
Oh, right, okay. So, but actually what I was wondering on this one, still wonder, inappropriate behaviour directed towards staff, that, potentially inappropriate behaviour can be caused by elected members, and I actually wondered if there needed to be something there in terms of, education, in terms of the different, roles of governance and management. That the members have limited control over staff.
And it's certainly one of the, sorry, for you, Mr.
Yeah.
Coates, this is, that's exactly right. And in conversations as a result of our planning for the election, there's going to be talking about how we properly onboard newly elected members.
How you work, sorry? What's that?
Newly elected.
Onboard
them into their governance roles. To go through the code of conduct, through the employment relationships, their interactions with staff.
Yeah.
Acceptable boundaries of behaviour and yeah, so that's, you're absolutely right.
But more than just code of conduct, yeah.
Yes.
Yeah, okay. Thanks.
Something with some teeth.
Just with the emergency manager, just a couple of questions from me, just so I can clarify. I didn't actually go into the report where they should have been picked up, but when I was reading the summary of the annual, it says page 95. It's got a very interesting point here. It's the second bullet point of key areas of risk and weakness. I'll come back onto the other one, but while looking at the report, it says an increasing dependency on official warnings. And 49.5% respondents expect the text, which may put them at risk. Is this, why don't I just, you flesh it out for me a bit more? I mean, this is interesting because, of course, the national texting system, etc., is just a person that gets texted, well, as part of that, you know, is reasonably important. But is this more a case of where it's really saying the community is reliant on being informed rather than actually what's in front of their eyes and what they're experiencing?
Yeah, absolutely. And this is the challenge, I suppose, where information is so available that different countries do it a certain way. People see that and therefore expect New Zealand does it the same. So, for example, there are no tsunami warnings in Wellington, and people might expect there is. So if there's an earthquake, they might only evacuate if there's a tsunami siren, for example. So the challenge with official warnings is if there's a significant event, because we can't rely on the technology to survive the initial event at that point in time. For example, now most is very resilient and it's national infrastructure, etc. You can't plan for everything. So the advice and the communication that we provide community is, as you say, it's long or strong, get gone.
Yeah.
You can tell yourself it's best to be safe and judge it yourself. So yes, the official response is obviously very important, but the majority of a response in a large event will be done through individuals and the community. So that starts with their behaviours and understanding actually the official response is there to try and provide a safety net, but realistically they need to also take charge of the action.
Sorry, no, that was quite a risk question. It was more just to pique my interest. This may be, and this may be in effect, what you were talking about, which is the professionalisation of what we're doing here in South Y, but effectively with the 3 Ys. Looking at this, as you say, I think there's a self-assessment, or at least assessment across the 3
Self-assessment. So each,
it's got a, it hasn't been externally verified. I know, not a problem, but because I think sometimes we self-assess ourselves harder than we possibly are. But it's face value on page 116, 117, and I think page. Well, it's up correctly the way I read it. This is really a summary of what goes. There are, and so guided by colour, which is not particularly astute way of reading reports. See some red, see what they're against. That they are sort of foundational blocks for building good emergency management. So it's this sort of thing now that professionalising active sense a new emergency management office.
Yes, absolutely.
Start to address.
Absolutely. And furthermore, there is an awful lot of information out there that's been conducted through Victoria University, through GNS Science, through the Lifelines organisation that's done some amazing work that can give us insights into where our various areas of risk are as a district. What the work, the risk landscape will intend to do is to overlay those insights, those reports onto what our community tells us are their issues. For example, around community isolation, if there's a road that gets swept away, in order to help inform a future discussion, a more integrated discussion around infrastructure investment, you know, and where we need to add further grunt into our investments.
As it relates to climate change.
Absolutely.
Yeah. So I'm not looking to see the plan or whatever, but I take it then from what you're saying, we're working with the other two to redevelop an emergency management response in effect, but the office. So somehow this is being put into a strategy, a plan to improve.
That is what's going to happen.
Yeah, so you're right. I get the GNS deal stuff kind of free. They're doing that. We're lost to learn from. What I must confess is controllers are able to provide effective leadership, and we were in the red. Critical resources can be sourced rapidly in response to an emergency. We're in the red. So we're assessing that if we don't get a lot below, I think you've said at the start, you know, South Y looks like it's listed. That's the sort of thing I'm thinking. What comfort can we have that this is in our eyeballs and we can do something about it?
Previous report that Matt brought to the table around our structure and identifying those key release positions against those that aren't, and the level of training that we've got in the organisation is how we respond to this. That is not necessarily the same across the board. I have a very strong view around civil defence and everybody being trained. And I think, you know, this is a Wairarapa response as opposed to a South Wairarapa response largely in here. So where some of these things are red, they're not necessarily red for us.
No, and we you only have to look at when Hinakura Road went, for example. That wasn't a declared emergency, but for the residents of Hinakura, it was. It meant social isolation. It meant a 45-minute detour trip to get into Martinborough. So we have to think about, we have to almost redefine what an emergency is for the community, and then think about what they need in order to carry on with their day-to-day lives. Now, one insight that I will give you is that in the very early stages of the Lifelines reports research that was being done, which is a fantastic piece of work, but an analysis was done of the South Wairarapa in terms of supermarkets. And unfortunately, they took a population-based approach. So apparently we didn't have any supermarkets in the South Wairarapa. Right, so from our perspective, we know we've got supermarkets, but we also know we've got home kill facilities, we've got butchers, we've got whatever you'll need in order to survive. And a very different approach needs to be applied now to how we work and how we understand our needs, wants, desires, risks for the Wairarapa. Yeah. And on the Hinakura example, Admiral's Road, part of it's in South Wairarapa, sorry, part of it's in South Wairarapa, most of it's in Carterton. So unless we work as one,
that's right.
we won't be able to plan as one.
I look total support from me that we're working as one.
Chair, Paul, is this a space as well where community boards need to, on that, so community boards need to step up and do, I mean, I know they have been active already in terms of running emergency management, sort of open days and things. But
yeah, absolutely. Getting the message into the community is absolutely key, and community boards play a big part of that. I know the Martinborough community board has been active in that space, especially building resilience around water tanks and preparedness. So the more that we can do with all three community boards, that's always positive from an emergency management perspective.
Lost my page now, but like, was it 37% have done water and 59% don't know where to go?
Yep.
And at the beginning of
It's
the,
on page, yeah, it's on
Yeah.
page 95, with 9% of people
Yeah.
don't know where the nearest hub is located.
Yeah, which is given,
and that in itself is a challenge because the word hub, under the emergency management terms, there's a formal use of the word hub. But our communities don't need to know that. They just need to know whether to come together and to get resources, right? That's right. And at the very start of the triennium, I did a presentation to each of the community boards and strongly suggested that emergency management should be included in their community plans. You know, we've seen a gradual uptake in that, and Martinborough is one good example of how that's worked really well.
Brilliant. Thank you for that, Matt. This is, you know, I think it's something we, as you've done helpfully for us, all notice things like climate change, the other even SFA, we've got. Great to see this sense of the plan going forward. I'm not going to say that we totally close to this, but it will be good at some stage in the future, and I'll leave it as an open question to see how this has gone, because it's great to hear about what's happening. It'll be good to get to that perhaps, I say at the start of next year. Are we there, or you know, whatever, you know, that would be good for the committee.
Excellent, thank you.
That's brilliant. Well, thank you again, reports, Matt. Thank you for your time, buddy. Appreciate that. That's a bit of information, and it was great to crawl through it. But I have a sense that I'm going to go to 3:30, so could I just suggest that right again, yeah, we'll just take a 5 minutes break.
Yes.
And we'll do it. How's that? Sounds like a plan.
Thank you for giving us a chance for a short break, and I do appreciate you folks to be here with us. What if we could move on to, I think it's our second last item, of last substantive item of the open session, which is capital project summary.
Look at the page, please.
132. It's 132.
I think.
Well, maybe this one.
No.
I am famous for trying to speak agendas by the paper, which I've never been able to succeed on. So,
I think
and I'm
that's
not
the
going
questions
to
are.
skip this one either. Second and James, you guys come up, that'd be great, please.
Oh, it's just I've lost my place.
Hey, look, so thinking of you guys, I've not met any of you, so Bruce would probably guess one of our Bruce Roberts, the people chairs, so I'm deeply appreciative of you being here. Started, so this afternoon, and so look, again, salient points from your report before I invite committee members to raise their questions. Thank you. I'll even my answers, so you take it.
Thank you, Chair. Kia ora koutou, everyone. I'm Stephen Orbit, in case you don't know who I am. Lovely to be here. I'll take the paper as read thoroughly by you all, and I just would note that as Charlie mentioned earlier, we're on track on roading in terms of budget to forecast. Water, we're behind, but that's explained by some large projects coming out of the financial year. And community operations is behind as well, as the team will go over, but there's some significant work expected in the final quarter, which is going to dramatically improve our numbers. And we also do have the impact of some large projects like Greytown Green Space and Greytown Wheels to a lesser extent Carkeek, which haven't been able to be progressed, and that's impacting on our overall delivery numbers.
Thank you, this.
But there's a lot there. I won't traverse it all. I'd rather get into a conversation with you.
Thank you. Appreciate that, Stephen. Thank you. I think we decided on a place.
Yeah, I mean, like Stefan, I'll take it as reading as far as community operations go. We're building capability, as talked about in the report, both through professional development, having staff now in seats, which is great, outside of the asset manager role. A lot to deliver. We're predominantly in the delivery phase or planning phase, and we're actually quite nicely ahead of where we said we'd be at the last staff meeting and just. Which is great. And like Stefan said, a lot to deliver with some fairly significant projects of weather dependency. So now is that prime time, now that we're out of the holiday period. So I'll really just see these questions.
Brilliant.
Yeah, a couple of questions. Thanks, James, Stefan. My questions are around the Tauharaneka pipeline and the Wheels Park. Pipeline delayed again, still not going ahead, we've heard. Now we're talking April, May, like this is, this is a constantly shifting goalpost, right, with these guys, when we're going to start. And my other, so this is more a comment really on the Wheels Park tender, and when I read the letter from the people who said we can no longer do this because we're now committed to their projects in Hawke's Bay. And, it was poorly worded, written, really sort of shouting like, sorry, we can't do this anymore. What was a $1 million plus contract? I'll question that. How did someone like that get the contract in the first place? That's more of a comment than a question, really. That I just was like, this was, literally like written down on a bit of A4 torn from a school book. It's kind of what it felt like to me. But anyway. So where are we at with that? The Wheels Park again, because it's going to come up again. And we're hearing from this morning's conversation as well with CD that what's going on there. All feels a bit grey, to be honest.
So On Whakaranakau pipeline, councillor, I mean, I think all of us are in complete agreement with you that the successive delays to that project have been unacceptable. We've certainly made representations to Wellington Water at every level of our organisation. Councillors, in fact, have also voiced their concerns to Wellington Water. There's a lot of reasons being given to us from Wellington Water about the delays. Now we're actually in a tipping point where the anxiety that we have is that the construction period will bleed into the winter, and the work in the river will be become an impossibility. So, but we've pulled all the levers we can to try and make this happen. We certainly will continue to apply pressure, but we haven't been successful in that project stay on target. I think in relation to the second issue around tender, we tender according to our procurement policy and we follow it strictly. So when a company is successful, they're successful because of the quality of their tender, their price, their reputation, their ability to perform the contract on time, all the normal standards that you'd expect in a professional tender or professional procurement system. But companies do withdraw from contracts for different reasons. We've had one company become bankrupt recently and not be able to complete the pedestrian lighting project. This company that was going to be doing the Greytown Wills Park, we were very excited about because they're very, very good in the industry. But some overlay on a project that they were working on meant that it became the last project that they did before they wound their company up, as I understand it, and they were unable to progress. These are things that they're not in our control, and they're certainly not visible to us when we go about the process of engaging a company to do work for us.
But as we've said in here, we're pushing that again. We've already assigned extra funds to this. You know, the speaking, it's only going to get more expensive. There is no more money for it. So we're going to get less and less bang for the buck, right? Which is going to be, I feel like we're in a sort of catch-22 here going around chasing money, chasing our tail, and there's still no progress.
So,
I was going to say I can give some more context around the next stages for you if you'd like. So we're looking at working with the runner-up tender from last time, who have a very good reputation in the industry, and looking with us at ways that we can adapt the original plan for free. They're keen to do that for us so that we can make sure that we can fit it within our budget and perhaps make it work in a slightly more cohesive way. We've looked at more of the without getting too technical around skating, making sure that the flow is good and that it's a perhaps even more successful product at the end. But this company is very excited to work with us and see. We haven't completely awarded it yet, but looking at ways that we can do that to minimise the disruption to the timeline and not reduce too many of the features, if any, that don't actually serve a more positive purpose at the end of it. So
can expect a full report back on that fairly soon.
Mhm.
Thank you, Chair.
Thank you.
yes, I think you briefly referred to it. The lights in the square here, will they ever be turned on?
So thank you, councillor. The project in the square to upgrade the pedestrian crossings, including the lights, which was the primary concern here because of the health and safety issue around the square being lit, was 90% finished when the company MMS notified us that they were to cease trading. The only thing really which is left to do for Martinborough is to plug it into the mains. Now,
Can it take so long?
we have assigned another company to do that, and the work order's been issued. The delay that we've got there is we're seeking mainly the electrical certification that MMS holds in order to understand what's been done, what's been certified, what hasn't, and the physical how of where the job is in terms of plugging it into mains. So but it is very important that we get that right.
Yeah.
And we are working, councillor, as fast as we can to finish that job.
Has it really got a high priority, has it? Because
It certainly is.
that's good. Yeah, because. Thank you.
Thanks, Bruce. Yeah. Stephen, just getting back to the Taranaki pipeline again, because I'm just a bit when we approved funding for that, it was done under a degree of urgency. The risk to total loss of water to Featherston was a real risk, certainly in terms of any damage occurring to the pipe going across the Taranaki River at the moment, as it stands at the moment. The risk, my understanding, hasn't changed. I mean, there is still that risk that we get a flood event, we could actually take out that pipe. Is that not correct?
Yes, councillor.
I mean, this is how it was sold to us at the end of the day, and this is why we chose the option that we did. So the risk hasn't changed at all, and yet the delays in getting this work done are substantial. They're not minor by any means. So my question to you is, at the end of the day, who are we going to take to task over this? Is it a Wellington Water problem, or is it a contractor problem, or what problem is it?
Yes, councillor, the risk is still there. A flood event or a severe weather event could bring a boulder or a log into contact with that pipeline, which is semi-scarred, so it's floating in the river in the worst possible situation. And the consequence is significant, because Featherston Township would be without water. And then that would cost the council an enormous amount of money to supply the township with water while we made an emergency repair to a asset in the middle of a river that's in a flood. So it is enormously important. It's a critical risk. And so that makes the fact that we've experienced these successive delays from Wellington. It's not a contractor problem, it's not a council problem. I can hand on heart tell you that. It makes these successive delays very hard to understand. But I'm sure my CE will support me when I say that we have done absolutely everything we can to ensure performance of that project. There's nothing left that we could do to make Wellington Water do this project.
So why are we continuing to ask Wellington Water to complete the job for us? Why are we not bringing it back in-house and doing it with the expertise we have?
That's a very good question, councillor. And in some instances where it's a wastewater pipe that might need replacing, or something like that, which is a fairly a technical job, but a job that a local contractor could do for us, we would have exercised that option. We would have taken that job back potentially and started to project manage and do it ourselves. But in this particular case, this is a high pressure pipe. It's a single failure asset, very important asset that we're running through a bed. It requires some specialist knowledge and specialist equipment. It's been assigned to someone that we are told is able to do that and do it well. It's not a project that I believe we would be comfortable bringing home. And so that's something we've thought about, but it isn't something we can do in this particular instance.
So in 3 months' time, are we going to be still having the same conversation, or do you think we'll get some traction under it between now and 3 months' time?
I think if the weather plays ball, councillor, we'll get it done prior to the wet season. But I can't guarantee you that.
Thank you, Stephen.
I do want to make sure that we leave this item on a positive note. So I
don't know how you can do that.
and I just want to say that that the community operations team that James O'Connor is responsible for has done a very good job of improving the quality of the reporting that you are seeing. And the dashboards certainly a reflection of the work that Melissa and James have been putting into this. And I think what that's allowed to happen is for you, Chair, and the team to be able to recognise the amount of work that is flowing through this team month by month. And you will notice that there's some very significant and expensive projects that have been landed. You know, one of these is the Greytown Pavilion, which is this incredible asset that now stands in Soldiers Memorial Park. And we opened it, I believe, last weekend, 2 weekends ago, which had, how many hundred people? Yes, 200 people. An amazing multi-purpose asset for the community that represents an enormous amount of work. And you're starting to be able to get proper visibility of these important community assets that are being delivered by James and the team. And I just wanted to take the opportunity to commend that team on the amount of delivery that's happening and how they're representing it to you. Chair.
Thank you, Stephen. I appreciate that, and look, I want to acknowledge that too. So do appreciate that. It is a bit of our role to focus on risk areas, and again, Colin, that's a very interesting discussion you raised about risk and risk appetite. And of course, here it raises questions around smart purchasing. So I'm happy to have had that conversation. Also glad to hear the changes, and I will be glad to see what those changes accrue as we go through it. Stephen, I don't know if you're in the room, James, well, you've heard, you know, even through our financials, we are interested to see where the CapEx is because of the impact it has on our debt position, obviously interest costs, but also this relates into our broader discussion around strategic risk and critical asset failure, and, you know, obviously the pipeline is so it is all related, so it's very helpful. I'm very comfortable. I don't know whether this is where you want to develop, you know, the dashboard is where it's fully developed. Could I just ask consideration, because this is really helpful. I want to keep us as a committee at a higher level. There's a lot of good information here, but my interest is for a risk committee. You know, what is really at the front end of the dashboard, which is actually what's the flow of work, and indeed the page where you've got, quite frankly, projects with a level of risk, and you've done that. So you've used my tick box. Well, thank you. I am always interested in the nature of our scheme, particularly between renewals and new assets. I get quite interested is actually from a financial sustainability perspective. Are we maintaining our existing asset base? The new assets are good too, don't get me wrong. And James, probably like coming to your area, I'm very keen to see how they're going. But I'm also very keen to see that we are running our renewal program as well. It's almost sort of phase one of being large asset owners. So I don't know whether that's easy. And you come back and say, Bruce, I can't get it. But I would be interested to know whether the dashboard date, well, the percentage completion for renewals versus percentage completion for our other projects. Thank you for that. Appreciate that. That is really helpful, Stephen, James, and Melissa. I realise, Melissa, you were at the last meeting, weren't you? Yeah, they sent you along, so it's nice to meet your colleagues as well. So thank you for being here as well. I appreciate that. And again, I think we're just taking this as a report. Information purposes, and I do appreciate that. Thank you, all three of you.
Thanks, James.
Let's move to the open, which is the action items. Amy, all anything we need to note there. Insurance. Open.
4.4 is
discussion.
Yeah, and to look at the going to Marset for
Insurance provider.
Insurance provider.
which ties into, your earlier risk appetite conversation. So, yes.
I'm okay, not a conflict, but I do want to recognise that just by the size of their portfolio, I can't get away from Aon and have a lot to do with Aon. They do a lot, but it's been interesting to explore the value of collective action around insurance risk, and I appreciate this what you are. So that's always an important start to the process.
You were hoping that we would get the LTPs that locked in. And then we would, while we were in the phase, Charlie would be able to link up with the other two CFOs to do the market test for the provider. So it is still definitely.
So we're talking about
do it together, just to reduce the broker arrangements.
Good.
Yeah.
No, that's good. Thank you for that. We'll take that then on. I know we need to, that's just give you some advice. That gets us to the end. Thanks for that. That gets us to the end of the open session. We have cyber security and legal. We've got the reasons there for it. They are both reasonable to take these matters into PX without topic interest. So can I move from the chair? We move into
I'm happy to see that.
Any discussion on that motion? Like hold on just in case you want to have a debate, you don't. In that case, I'll put the motion. All those in favour, please say aye.
Aye.
Those against, it's carried. Thank you. Amy, when we can carry on.
Where am I going to?
Looks like